Okay, we've got a report that's going to be out on Friday. A lot of talk about the world supply and demand estimate. We're going to go to the edge of the trading floor in just a moment to see what Scott Gecas has to say about that. But first, let's look at these futures here, Scott. I want to go over here to the corn market as we get started. You know, today we're about the same as what we were yesterday. 0.75 cents lower for March. That new crop in December is down 0.75. Scott, this market just continues to just kind of leak lower here just a little bit. Are we going to find support pretty soon, you think?
Yeah, well, it's all going to determine on what is going to come out of this report that's going to come out Friday. So we're expecting the stocks to be lowered. We're expecting production to be a little bit lowered, but demand is expected to be increasing. So we're also expecting China to be a little bit of a larger buyer of U.S. corn. It just hasn't come in yet, hasn't materialized yet. So that's why you're seeing a little bit of consolidation, a little bit of a movement lower, but really not too much of a concern one way or the other. But we're going to, once we get that number out, you know, this is a very important number. It should have some definitive movement based on what is going to come out on the USDA. So that's what we're keeping our focus on. I can tell you right now, just with the funds being net short, the calls are still holding a stiff premium over the puts. So it's going to be really interesting to see how these markets are going to react based on that number. You know, if you flip over to the soybean side, I could tell you last week we were looking at the call skew being about $4 above average, meaning that you're going to pay $4 more for upside calls and rather than downside puts. Coming in Monday, that completely flattened. Now, after the tensions back and forth and with a little bit of a drop overnight in soybeans and then recovering, that skew went to +2. So calls are being roughly priced in about a little bit, about $2 worth of premium to the call side versus the puts. So that's significant. But, you know, going into a report like this, we expect that volatility and that skew to flip back and forth. We're just keeping a close eye on that.
All right, March soybeans, that's our next front month because January's in delivery. We're up 3 at 9.47, May up 2 1/4, and August is up 1 3/4 cents. For the wheat market today in Chicago, March is down 1/2, July is down 0.75 cents. Kansas City wheat market, and we've been watching to see if this market would be able to close any gap on that Chicago wheat. March is up 1/4, May is unchanged, July is down 1/4. So a little bit of mixed action over here in the wheat market. Any reaction to the wheat seedings number estimate that was released, Scott?
Not really, but you know, with the number coming out and with the phase 1 being supposedly signed on the 15th, I think the biggest markets that are going to have the positive reaction are going to be the wheat market as well as the cattle. So those are the two surprise markets that are going to be in that phase 1 deal if it gets signed. We're still waiting for confirmation on that and what is actually going to be in the details of that phase 1.
Hard red winter wheat seedings expected to come in at 22.1 million acres. Soft, 5.1 million acres. White wheat, 3.4 million acres. That'll leave us with a total of all winter wheat at 30.7 million acres. It's kind of a narrow range of guesses there. I was talking to one analyst this morning, Scott, who has clients in Kansas and said much of that area, you know, such dry weather, some of the acreage is down there, and some of the wheat doesn't look so good either. All right, we'll take a break. We'll be back in just a moment. Stay with us here on RFD TV and Rural Radio, Channel 147 on Sirius XM. We'll stop over here at the futures, and then we'll go back to the edge of the trading floor first. Live cattle futures today after a little bit of a sell-off this morning early on. February down 30, April down 53. 126.22 is where we're trading that February live cattle contract at. We've got asking prices at 127 for cash. Let's look at the feeder cattle market. Now with January, our month that will be expiring here pretty soon, it's up 3, but March up 38, and the April is up 13 cents at 147.93. On to the hog complex we go with the February up 58, the April up 30, but the May is down 20, and the June is down 7. The pork packer margins starting to fluctuate again here just a little bit. In fact, we see where the pork packer margin was actually lower than it was back on January the 6th, a couple of days ago. Yesterday, $42.25 is the standard margin. The day before that, it was $46, but you go all the way back to last Friday, and we were at $43.90. So, Scott, first question here is we watch these packer margins fluctuate a little bit. Obviously, that'll influence cash a little bit. Cash having any influence on hog futures at this point, do you think?
Not just yet, but with the cattle market, with the Packers margins dipping a little bit, we're keeping an eye on that cash. That cash is going to dictate where the trade is going to go, but also you guys also got to throw into a factor that, the Australian wildfires are definitely having an effect on their exports. So with all the fundamentals and the strong uptrend in the cattle, it's going to take a lot to reverse this upside trend. The biggest thing that we're going to be watching is that cash trade. If we see that cash trade dip below 122, 120 or so, we expect that liquidation to start to come into effect. We have the funds that are net long. They're reducing their contracts already, even with the steady cash. So if we see that dip in the cash, we expect that liquidation to take full effect. You're going to see a spike in volume as well as a spike in volatility.
Scott, is anybody on the floor talking about the activities from last night? Is there any nervousness in the market here today?
Yeah, coming in this morning, that's all everybody was talking about is what was happening last night. So if you look at just the regular futures, the S&Ps, they got crushed overnight as soon as they announced that they had retaliation. Coming in this morning, they regained all those losses, and now they're even up slightly. So, because they weren't really, it wasn't too big of an attack, I guess. Not that any attack is light, but still, it wasn't as much as we expected or as the market expected. The biggest factor that you're going to be watching is any disruption in the Strait of Hormuz is going to be the biggest factor in all these markets.
All right. Thank you very much, Scott.